Hi everyone, it's Grace. Welcome back to my channel. So since last week's FOMC meeting, there has been a lot of negative market reaction to the equity market and also the bonds market. So basically the Fed announced a 50% basis point increase, and it did. And then also the balance sheet is shrinking by $47.5 billion per month starting in June 1st for 3 months, and then afterwards it's going to double. So what the market is taking is that, oh my gosh, like the Fed is shrinking the balance sheet, and then that has a lot of impact, negative impact on the balance sheet size, both for businesses and individuals. So that's why like the market is saying, let's just get out now before things get out of hand. So that's like the major direction. And I'm also hearing a lot of situations in the market that the 2008 recession is going to repeat itself again in the post-2022 era. And like personally, I don't like fitting an economic situation into what I call a theory box. I mean, we can definitely look at some of the economic theories and also past experience for a reference. But because there are a lot of like unique events happening at the same time, it doesn't necessarily fit into those boxes. So, on my channel, I like using very, very simple logic to explain complicated economic situations. So that's also what I'm going to do. I'm going to give you my fresh take of what I think is going to happen for the next few years. All right. So before we begin, remember to subscribe to my channel and click on the bell button so you'll get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. All right, so let's start. What's unique about 2022 is that, so one difference between 2008 and 2022 is that there is a lot more financial literacy for investors. You can, like, for example, you can view the live streaming for the Fed's meeting like right from your phone. And also the government's meeting, the Treasury Department, and all the monetary and fiscal policy meetings are happening like right before your eyes. So investors can actually see those policy risks before they happen. So they're well prepared beforehand. And then some of the events like a major pandemic and also labor shortage, supply chain shortage problems that are simultaneously happening. That creates a very unique situation. So the first thing that I want to mention is that the stock market has absolutely done like probably the worst since the pandemic, especially the tech stocks. And when I look at some of the companies that, for example, it's mentioning on this article, I actually see a mix. Like some companies are still doing pretty strong. They're earning revenue, but their stock price are just like tanking. And there are also others that are not, their revenue is not doing so great, and then their market price is also tanking. So there's a mix. Saying that the Fed is like crashing the market is probably true. But the other thing, saying that the economy is like, the economy itself is crashing, that's not really true, because the economy is still strong. There's still very strong demand from consumers. So let's just look at some of the companies. For example, like here, like Peloton is one of the recent companies that went public. Both revenues and its stock price is going down for the first quarter of this year. And I think one very key reason is that Peloton was like its position is singularity. There's only one product that sells the bikes, and it took off when the pandemic hit, right? Because people had to stay at home and then they couldn't return to the gym. Like afterwards, when COVID is over and then people are back to the gym again, nobody buys the bike, and it's expensive. So like one little policy change or one situation changes and the whole business is affected. So I think that for tech companies such as Peloton, the risk is very obvious, and you can actually see it. So the thing I'm going to do is that I'm going to look at the current market price for Peloton. So you can like literally see it's going all the way down. And then the other thing that I also reference is the, its current earnings per share. I'm not going into those like super detailed and technical analysis at this point. I'm just going to show you, like, for the past year, you can actually see that the actual earnings per share is like underperforming based on its estimate. So like it's literally like losing money. So for this type of tech stocks, I do think that it's slowing down quite a bit, because it wasn't able to continue its business or momentum once the pandemic is over. All right. So the next company is like, well, we know that Netflix like dropped like 75%. It's like crazy. And one of the most important reason is because there's a lot of market competition in there. There's Disney, there's Hulu, and there's also HBO Max and all the other like streaming services. And it doesn't bring in a lot of like new content to attract people's attention. And I think for Netflix, it also like increased its price twice and also cracks down the password sharing. There's a lot of things going on in there. So it's like losing subscribers and losing revenues. And then it's also hit by the Fed's decision. So there's a lot of mix in there. And the other one is Zoom. Actually, when we take a look at Zoom, its stock price is going down, but when we look at the EPS, it's actually doing better than expected. So this definitely tells you that the economic activity in this market and for this company is still strong, but because the Fed is shrinking or indicating that it's going to shrink the balance sheet next month, the market portrays it in a different manner. So just pay attention that, business still has to carry on. No matter it's in an economic boom or bust, there's still a demand there that needs to be fulfilled. So the other type of asset is crypto, and we've seen crypto crash for the past few days. That is like bleeding, right? Right now, let's take a look at the current cryptocurrency market. What's the price? So it has like Bitcoin has dropped below 30,000, and then Ethereum below 2,000. So that basically tells me that crypto asset is it's not like a very valuable or collectible. It acts more like S&P 500. This actually is a surprise, because I did sort of like a poll a few months ago asking you, what do you think crypto assets such as Bitcoin will perform? And a lot of you say that it's going to be one of the most inflation hedged asset, but this is actually a surprise. I'm very surprised to see that crypto asset is behaving exactly, I wouldn't say exactly, but very mostly like the equity market and S&P 500. And also this costs like Coinbase to its revenue. It's not just the stock market price. Its revenue is dropping by 27%. So basically people are exiting the market. They don't want to take on more risk than they could. And they also want to, cash out before things get out of hand. So that's basically what I'm seeing here. So That's what I mean. Don't try to fit into a theory box, because that's sometimes that's not really helpful. Understand one type of asset performance according to the market reaction is the most reliable source, that you can rely on when you're looking at the performance, when either you're investing now or in the future. Just look at the real market reaction, and that tells you, what type of asset that actually belongs to. All right. So for those of you who are holding a lot of like cryptocurrencies, just pay attention that, maybe follow the S&P 500 a lot more than say a piece of like art collection like Monet or Picasso, right? All right, so the next thing that I want to emphasize is that the stock crash and obviously crypto crash does not necessarily mean that the economy itself is tanking. So a lot of investors are cashing out right now, right? So the asset flow is transforming from the equity market to holding more US dollars because people no longer wants to play the game. However, this means that consumers or regular investors are holding more cash in their pockets right now than before. So they're actually just like switching what type of assets they want to hold. And then this actually creates an opportunity for companies and corporates to finding ways to either do a different pricing or a different market strategy to encourage people to consume more. So I do think that you need to pay attention to what does the stock sell-off mean? Does it mean that the economy is like going down, like crashing? It doesn't necessarily mean that at this point. So the next thing that I want to talk about is the high yield bond and also the treasury securities yield. If you're not familiar with the bonds market, the thing you need to understand is that if a bond's grading is really good, it should have a low yield, because the interest on a bonds is fixed. So that's basically like a fixed income asset, right? And then how good of a bond or how popular of a bond is according to its market price. So for example, if a bond is worth $1,000 per share, and bidders are probably willing to pay for it for $50 more or $100, right? So that basically brings down the interest rate. So that's why low yield bond actually performs better, and it's a better income than high yield bond, because high yield bond actually people are not willing to pay for it for $1,000. They probably underbid it by $50 or $100. So when interest rates are going up, $1,000 bond will probably only sell for $900 or $800 or something like that. So what does that mean? That basically means that you're lending money to a company that's high risk, but you're not collecting enough interest. And in fact, you're losing money by lending that company money, right? So that's basically what it means. So the other term for high yield bond is junk bonds. And there's a lot of things going on right now in the junk bond, like people and either it's individual investors or institutional investors, they're dumping the junk bonds. And when they're not attractive anymore and there are not many buyers out there, they're going to underbid the price. So that's why the yield on the high yield bonds are like going up and up, and their default risk is getting much higher. And at the same time, the other thing that I'm seeing is that the treasury yield is dropping a little bit. Like for example, like for 10-year treasury yield, it used to be like above 3%, and then now it's back to 2.9%. So basically, like investors are like, they're kind of dumping the junk bonds or high yield bonds and going to like really safe bonds categories like the treasury securities. So that's why the yield for treasury securities are like lowering a little bit, because there's like sort of like that market movement there. So the last thing that I want to mention is that yesterday I did a poll asking you, do you think the labor shortage will continue when a full-blown recession hits? I don't know when it's going to happen, but when that happens, two things are happening. The first thing is that the Fed funds rate is peaking. It could be 5% or above that. I don't know at this point what percentage it's going to be. And the other event is that the Fed's balance sheet is shrinkage stops, right? So those events are going to trigger or they're synchronizing with a full-blown recession. And then I'm actually surprised to see that there are 39% of you saying that, you know, the labor shortage will still continue even though a full-blown recession is going to hit. So that basically means that you're aware that the labor shortage problem is not just caused by, you know, the quantitative easing or QE5 that kicked in when the pandemic started. It's unique, and it has to do with early retirement. It also has to do with like low birth rate, and you know, just a lot of like very unique situations that are not triggered by the Fed's monetary policy. All right, so that's pretty much for today's video. And then I'm like right now I'm still waiting for some of the data to come out for the housing market for April. So stay tuned on that one because I will be updating very soon. All right, so this is pretty much today's video, and I hope you enjoyed it and find it useful. All right, and I'll see you on the next one.